Welcome to the Securities Industry Essentials Exam Review. We have a lot of material to cover, so let's jump right in. Our goal here is not to teach you everything about the securities industry, but to help you pass the exam and start your career. We'll focus on what's on the test, how things are tested, and how to come up with the right answers. Understanding why a company might declare a stock split, or why an investor makes certain choices, is less important than knowing what happens when they do. As we go through the material, I'll highlight key points that you might see on the test and share tips to help you answer those questions. Along the way, we'll also touch on some fundamental concepts of the securities industry. We'll need to cover some concepts and terminology you might not be familiar with. Let's start with Chapter 1, Equity Securities. So what are equity securities? Simply put, equity means ownership. When we talk about equity securities, we're referring to shares of common stock or preferred stock. Let's dive into the details. Section 1, Common Stock Basics. Before we dive in, let's take a moment to step back. Imagine you're a corporation trying to raise capital. You have two main options. First, you can issue shares of common stock, which represent fractional ownership in the company. People who buy these shares now become owners of the company. Second, you can borrow money in the form of debt. In this scenario, the company is the debtor and the investor is the creditor. Let's begin by examining equity securities such as common and preferred stock. We'll cover debt securities next. As I mentioned, owning common stock makes you a partial owner of the company. That means you share in the benefits and rights of ownership. We'll discuss these benefits and rights as we go through the material. Bear in mind, a stockholder and a shareholder are the same thing. You'll see these terms used interchangeably throughout our discussion. Let's continue. Let's start with forming a corporation. We need a legal document called the corporate charter, which sets the rules and authorizes a certain number of shares. We won't sell all authorized shares right away because we're just starting out and hope the company will grow in the future. Registering stock to sell is a lengthy, complex, and expensive process, so companies will tend to authorize a lot more stock than they initially need because they don't want to repeat the process. For example, we might authorize 1 million shares but issue only 400,000 initially. Companies that issue stock are often called issuers. When authorized stock is issued, it is sold through an initial public offering, or IPO. This is also called a primary offering. These shares are then traded in the secondary market, which is another name for a stock market or an exchange, where public investors can trade them. Later, the corporation may decide to buy back some of these shares, which becomes treasury stock. Treasury stock is previously issued stock that the company has repurchased and is no longer considered outstanding. Outstanding stock is stock that is available to trade on an exchange. Because the company holds the shares now, it is no longer available to trade, meaning it is no longer outstanding. Now, let's walk through some examples to illustrate this further. So under the corporate charter, we're authorized to issue a fixed number of shares. Common stock does not have an inherent face value or par value. For common stock, it's an arbitrary and typically very tiny amount. For common stock, you just need to know its par value is basically meaningless for valuing the stock. However, par value is very important for preferred stock and for bonds, which we'll cover a little bit later on. With common stock, we're primarily concerned with current market price. Like any market, supply and demand determine how much people are willing to pay and how much people are willing to sell for. The stock market is forward-looking, so valuations are most often based on the value investors foresee in the future. So if we see the company has growth opportunities, we think it's going to be worth more in the future. Thus, we may be willing to pay more for it now. We're going to get into stock valuation a little bit later on in this chapter. Let's get back to those key terms. Authorized, issued, and outstanding stock. Here's an example. 1 million shares are authorized in the corporate charter. We decide to issue 400,000 shares now and hold back 600,000 shares for later. Think of companies like Amazon or Google. When they started, they didn't issue all their authorized shares because they expected to grow. They issued a few shares, used the money to fund growth, and as the company's value increased, they issued more shares. So in our case, we issue 400,000 shares and still have 600,000 unissued shares. We don't need to amend our corporate charter to issue more shares later. The issued shares are now outstanding and trading in the secondary market, meaning they're trading on an exchange. If the issuing company decides to repurchase some of its shares, those shares become treasury stock. Let's break it down. We had 400,000 shares issued and outstanding in the secondary market. If we repurchase 100,000 shares, these become treasury stock. Treasury stock doesn't vote and doesn't receive dividends. Think of it as retired. It's no longer available to be traded. Now, let's see what happens. With 400,000 shares issued and $400,000 in earnings, the earnings per share were $1. When we remove 100,000 shares, the earnings are still $400,000, but now they're divided among 300,000 shares, increasing the value of each share. So why would a company buy back its stock? This raises the earnings per share on its outstanding shares. It also shows the company has a lot of confidence in their prospects if it thinks the best use of its funds is to buy back its own stock. Now, you might see this formula. Issued shares minus outstanding shares equals treasury stock. Let's break it down another way. Treasury stock is issued stock minus the outstanding shares. Outstanding shares are the issued shares minus treasury stock. So if we issue 400,000 shares and buy back 100,000, we have 300,000 outstanding shares. Now, let's talk about your rights as a shareholder. Those outstanding shares trading in the secondary market give you the right to sell your ownership interest to someone else. How do you do that? By trading on a stock exchange through a brokerage. Where do you trade? Equities can be listed on an exchange, like the New York Stock Exchange or NASDAQ, or they can trade over the counter, OTC, which includes smaller stocks that don't meet exchange listing requirements. Regardless of where you trade your stock, you become the economic owner on the trade date. However, it takes a little time for the trade to be officially completed. This process is called settlement. Once the stock is purchased, the shareholder is subject to the fluctuations of the market, even though they are not officially registered as the owner until the trade settles. It is important to remember settlement for almost all securities is 1 business day after the trade date, often expressed as T+1. This means if I buy a stock on Monday, the trade settles on Tuesday, excluding weekends and holidays. This most common type of settlement is called regular way settlement. Let's move on now to Section 2, Distributions and Common Stock Valuations. Some stocks offer dividends, which are a type of beneficial distribution to shareholders. There are two main types of dividends, cash dividends and stock dividends. When an investor receives cash dividends, they are receiving a portion of corporate earnings. Alternatively, the company may choose to give investors more stock in the form of a stock dividend. Cash dividends are a portion of corporate earnings paid to shareholders. The board of directors decides whether to declare a dividend and how much it will be, typically on a quarterly basis. For example, if a corporation declares a 25-cent dividend in April, the annualized dividend would be $1, since dividends are usually paid quarterly 4 times a year. This helps with understanding questions about annualized dividend yield. Another way to look at it, if a company pays an annualized dividend of $1 per share, the quarterly dividend is 25 cents. Remember, cash dividends are taxable since you're receiving actual money. Stock dividends, on the other hand, give you additional shares instead of cash. While the number of shares increases, the value of each share decreases proportionally, so the total value of your stock holdings remain the same. This is not a taxable event because you're not receiving anything of immediate monetary value. We'll discuss the specific dates associated with cash dividends later in the course. Let's look at an example involving a stock dividend. Suppose you own 100 shares and they're trading at $30 a share, and you have $3,000 worth of stock. The company declares a 20% stock dividend. How much stock will you have now? A 20% stock dividend on 100 shares gives you 20 additional shares, so you'll have 120 shares. Has the company's value changed? No. The total value of your holdings remains $3,000, but it's now spread across more shares. So what happens to the price per share? It decreases. To find the new price per share, divide your total value, $3,000, by the new number of shares, 120. This gives you $25 per share. Don't fall into the trap of reducing $30 by 20% to find the new price. It doesn't work mathematically. Just remember, the total value stays the same, so divide that value by the new number of shares. Also, keep this in mind. A stock distribution of less than 25% is called a stock dividend. If it's 25% or more, it's called a stock split. In a similar situation, you're not getting anything of value, just more shares worth less. So why would a company do this? Let's break it down. Imagine a stock price is $1,000 per share. Stocks typically trade in round lots of 100 shares, meaning it costs $100,000 to buy a round lot. This price point can be a barrier for smaller investors. To make the stock more affordable, companies may issue more shares, reducing the price per share. This type of stock split can also be called a forward split. For example, if you own 100 shares at $50 each, your position is worth $5,000. In a 2-for-1 split, you get 2 shares for everyone you own, so you'll end up with 200 shares, but the price per share drops to $25. The total value of your shares is still $5,000. Again, the math is simple. The key concept is that with stock dividends or splits, the value of your position doesn't change. It's just divided among more shares. In a reverse split, like a 1-for-10, you get 1 share for every 10 shares you own. This is done to increase the price of each share, to make it more attractive to investors. So in this case, the price per share rises. The number of shares falls proportionally, but the value of the investment is unchanged. Now, let's discuss an uneven stock split, which you might see on the test. A 5-for-4 split is a bit trickier than a 2-for-1, but manageable if we take it step by step. Say you have 100 shares trading at $50 each, worth $5,000 total. In a 5-for-4 split, you get 5 shares for every 4 you own. You own 100 shares. Divide by 4, 100 divided by 4 equals 25. Multiply by 5. 25 times 5 equals 125 shares. So you end up with 125 shares. To find the new price per share, flip the ratio to 4/5 and multiply by the original price. 4/5 times $50 equals $40 per share. Another way to confirm is to divide the total value, $5,000, by the new number of shares, 125. $5,000 divided by 125 equals $40 per share. The best way to check your math is to make sure the overall value of the stock position is unchanged from before and after the split. Let's look at a question. A corporation declares a 2-for-1 stock split. For a customer who owns 100 shares at $60, how many shares will they now have and at what dollar price? Choice A, 100 shares at $30. Choice B, 200 shares at $30. Choice C, 200 shares at $50. Or choice D, 200 shares at $60. First, you know that with a 2-for-1 split, you get more shares. So option A, which suggests the number of shares stays the same, is wrong. Similarly, the price per share will decrease. So option D, which suggests the price remains the same, is also wrong. Now we're down to B and C. If you're unsure, you have a 50% chance of guessing correctly between these two, instead of a 25% chance if you included A and D. In a 2-for-1 split, you double the number of shares, so you now have 200 shares. To find the new price per share, flip the split ratio to 1/2 and multiply by the original price. Half of $60 is $30. So the answer is B. Another way to check. You originally had 100 shares at $60 each, worth $6,000 total. After the split, you have 200 shares. Divide $6,000 by 200 shares to get $30 per share. This confirms the answer is B. Let's tackle a slightly trickier example. A 5-for-4 stock split. Suppose a customer owns 100 shares at $60 each. How many shares will they have after the split? In a 5-for-4 split, you get 5 shares for every 4 you own. So if you have 100 shares, you'll end up with 125 shares. In this case, you divide 100 by 4 over 5. Next, let's determine the new price per share. In this case, we will divide 60 by 5 over 4. $60 divided by 5 over 4 equals $48. So after the 5-for-4 split, the customer will have 125 shares at $48 each. They started with $6,000 worth of stock, and dividing $6,000 by 125 shares confirms the new price, $48 per share. Let's talk now about preemptive rights. Some companies choose to offer existing shareholders a preemptive right to maintain their proportion of ownership when they issue new shares. You might also see this described as anti-dilution rights, because the idea is to stop an investor's share of ownership from being diluted by offering them the ability to maintain their existing proportion of ownership at a discount. If a person owns 10 shares when the company has only issued 100, then they have 10% ownership. If they later issue 900 more, then the investor now owns 1%, not 10%. Rights can also be referred to as subscription rights, because it is said that the investor subscribes to the offer to receive the rights. So we say the company allows pre-existing investors to preempt other market participants by offering them the opportunity to maintain their proportional ownership at a discount to the current market price. When rights are issued, shareholders have 3 options. First, they can exercise their rights and buy the new shares at the discounted price. For example, the stock may be trading at $20 a share, and the right will allow the investor to purchase them at $18 a share. Or the investor could sell the rights in the secondary market to someone who wants to buy them. Or they can let the right expire. If the stock price drops and you don't want to buy more, you can let the right expire worthless. Rights tend to expire within a few weeks of being issued. A lifespan of 4 to 8 weeks is common for rights. All right, let's explore the valuation of a company by looking at some key financial documents, the balance sheet and the income statement. These are important concepts, and understanding them is crucial. A balance sheet is a snapshot of a company's assets and liabilities at a specific point in time. This financial statement is produced at the end of the year. One key formula you need to know is net worth equals assets minus liabilities. Assets are what the company owns, liabilities are what it owes, and the difference is the net worth, which represents the value of the company. As a common shareholder, you own a portion of this net worth. Next, let's consider the liquidity of a company, the ability to meet its future obligations. When we say something is liquid, we mean it is easy to trade it for something else. So when we look at a company's current assets, we are describing those that can be quickly traded for goods and services, such as cash, cash equivalents, like securities, and inventory. On the other hand, illiquid assets are hard to trade, such as a factory or specialized equipment. Current liabilities are short-term obligations, such as interest payments on bonds, declared dividends, and operating expenses. Those would include paying the power bill, taxes, wages, and similar expenses. When evaluating a company, we need to look at several financial metrics, including the liquidity ratio, current ratio, and working capital. Let's break these down. The current ratio is calculated by dividing current assets by current liabilities. For example, a current ratio of 2 to 1 means the company has twice the amount of current assets needed to cover its current liabilities. This suggests the company is liquid and unlikely to run out of cash in the near future. This metric is also called working capital, quick ratio, or the acid test ratio. To get a clearer picture, we might exclude inventory from current assets because inventory can be less predictable. Damaged or obsolete products might not sell quickly. The quick ratio is calculated by subtracting inventory from current assets, then dividing by current liabilities. Here's a key takeaway. The current ratio and the quick ratio, or acid test ratio, help determine a company's liquidity. While you may not need to perform complex calculations on the test, understanding these ratios is crucial. The current ratio includes all current assets, while the quick ratio excludes inventory to give a more conservative measure of liquidity. Here's a balance sheet to help you visualize what we're talking about. It shows the company's current assets. That includes assets like cash, petty cash, temporary investments, and accounts receivable. Inventory is also included in current assets, but since it can be uncertain, we might exclude it when calculating the quick ratio. Net worth, also known as shareholder equity, is calculated by subtracting liabilities from assets. Shareholder equity represents the net worth of the company because it's what would be divided among the shareholders if the company went bankrupt. In such a scenario, the company would sell all its assets, pay off all its liabilities, and whatever is left over is given to the shareholders. To recap, net worth equals assets minus liabilities. Shareholder equity is the same as net worth. The current ratio is calculated by dividing current assets by current liabilities. The quick ratio, or acid test ratio, is calculated by subtracting inventory from current assets and then dividing by current liabilities. Now, another financial statement that you're going to look at as an investor is the income statement of a company. This statement captures profitability over a period of time. We start with the company's income and subtract the expenses of generating that income, which gives us our net income. Earnings per share is simply the net income divided by the total number of outstanding shares. This illustrates earnings on a per share basis. If the company were to offer dividends, then a portion of that income would get paid out as dividends. Here's an income statement. It's pretty straightforward. It shows what we sold and what it cost us to create, sell, and pay taxes. What's left over is the net income. We've covered the basics of the balance sheet and income statement and common stock, but how much is a stock worth? At the end of the day, it's worth whatever people are willing to buy and sell it for. It's a bit more sophisticated than that because we have analysts who crunch these numbers, influencing buying and selling decisions. For example, someone might buy a stock because they're interested in the income it generates. Take Clorox, for instance. It's not a high-growth company since there's only so much bleach people need. However, Clorox is a steady company that pays a reliable dividend. If I buy Clorox stock for the dividend, how do I determine the yield? Yield is the annual income from the stock divided by the current market price. Let's look at the annual dividend income here. Suppose the earnings per share are $2. If the company pays out half of that, it's $1 in dividends. For simplicity, let's say the stock is trading at $10 per share, and with an annual dividend of $1. In this case, the dividend yield is 10%. Another way to look at the value of a stock is by comparing it to other stocks using the price to earnings, or PE ratio, often referred to as the company's multiple. This means looking at how many times earnings a stock is trading at. For example, growth companies like Tesla or Amazon are expected to be worth more in the future than they are today. Investors are often willing to pay higher PE ratios for these growth companies. On the other hand, mature companies like Clorox, which may not have significant growth opportunities, often trade at lower multiples. Clorox is known for being a stable company that pays a good dividend, hence a lower multiple or PE ratio. Let's look at an example. Suppose a company's market price is $50 per share and its earnings per share are $2. To find the price to earnings ratio, divide the price, $50, by the earnings, $2, which equals 25. This means the company is trading at 25 times its earnings. This number alone doesn't mean much, but it becomes insightful when you compare it to other companies. For instance, if Tesla is trading at 50 times earnings, while Clorox is trading at 25 times earnings, it suggests that investors expect more growth from Tesla than from Clorox. For the purpose of the test, you need to understand that the PE ratio is calculated by dividing the stock price by earnings per share. This is a key measure of stock valuation. Remember, it's just simple division. Price over earnings per share gives you the PE ratio. Let's move on now to Section 3, Rights of Common Shareholders. As a shareholder, you have several important rights. First, you have the right to inspect the books. This means you'll receive annual statements from the company in the form of an annual report, which includes the balance sheet, income statement, and other financials. The company provides these annual financial statements to all shareholders. You also have the right to transfer your ownership. You can trade your stock in the secondary market, making it a liquid asset. Additionally, you may have the right to maintain your proportional ownership. This is where preemptive rights come into play, allowing you to purchase additional shares before they're issued to the public. It's important to remember that shareholders have the right to receive any corporate distributions, which have been declared by the board of directors. Common stockholders also have a residual claim to the assets upon dissolution. After paying off all liabilities, what's left is divided among the common shareholders. This makes common stock the junior-most security, meaning common shareholders are the last to get paid. Lastly, you have the right to vote on certain corporate decisions. That includes getting to vote for the board of directors. But do shareholders get to vote on dividends? No, they don't. If they did, everyone would vote for the highest possible dividend, and the company wouldn't survive. So shareholders do not vote on dividends. However, shareholders do vote on stock splits, reverse splits, and the issuance of more shares. For example, if a company wants to issue convertible bonds or convertible preferred stock, which can be converted into common stock, it could dilute your position as a shareholder. You get to vote on this before it happens. If the company plans to give stock options to officers, allowing them to buy stock at a lower price as a reward, shareholders vote on that too. This is because it can also dilute your position. More shares would be outstanding, which could affect the value of your shares. So while you don't vote on dividends, you do vote on issues like new stock issuance, stock splits, convertible bonds, convertible preferred stock, and stock options for officers. So here's a bit of a quirk. When it comes to stock dividends, we're issuing new shares, but they're being paid to existing shareholders. As an existing shareholder, I'm receiving that benefit, so I don't vote on receiving cash dividends or stock dividends. The same goes for rights distributions. I don't vote on them because they benefit me directly. In summary, cash dividends, stock dividends, and rights distributions all benefit me directly, so I don't vote on them as a shareholder. The board of directors handles those decisions. But if my position might get diluted, such as with new stock issuance, stock splits, or convertible bonds, then I do get to vote on that. Here's a question. Common shareholders have the right to vote on all the following except A. Changes in the number of authorized shares. B. Cash dividends. C. Board of directors. Or D. Stock splits. The answer is B. Cash dividends. Shareholders don't vote on cash dividends. But if there's a change in the number of authorized shares, an election for the board of directors, or a stock split, common shareholders get to vote. Here's another question. In a corporate liquidation, common stockholders are paid when? A. First. B. After creditors, but before preferred stockholders. C. After bondholders, but before preferred stockholders. Or D. Last. When do common stockholders get paid? Last. The answer is D. Now, let's talk about voting. There are two methods of voting, statutory and cumulative. Under statutory voting, let's say you have 100 shares, and there are 3 board of directors seats open. You can vote no more than your number of shares for any one director. So if you like all 3 candidates, you can give each one 100 votes. But if you only like 2 of them, you can only cast 200 votes, 100 for each of the 2 you favor, and withhold the remaining 100 votes. The other method is cumulative voting. Here, you get the total number of board of directors seats open, times the number of your shares. So with 3 seats open and 100 shares, you have 300 votes. You can distribute these 300 votes however you like. You could give all 300 votes to one director, 200 to one and 100 to another, or any combination you choose. Here's the testable point. Cumulative voting is considered advantageous for small investors. If you have 100 shares, you get 300 votes in cumulative voting. You can give all 300 votes to one candidate if you really want to make sure they get on the board. Proxies are used when voting takes place at the annual meeting, and you can't or don't want to attend in person. If you receive a proxy in the mail, you fill it out and send it back. At the meeting, someone will say, I have all these proxy votes. X number of shares yes, X number of shares no. A testable point about proxies. They enable shareholders to vote without attending the annual meeting. Another point about proxies involves broker-dealers who might hold a customer's shares in street name. This means the shares are registered in the broker-dealer's name, but the customer is the beneficial owner. These assets are segregated for safety, but the broker-dealer gets the proxies. What do they do with them? They must forward them to the customers. Proxies received by a broker-dealer must be forwarded to the beneficial owner. So that's common stock. Let's move on to Section 4, preferred stock. Preferred stock is still ownership in the company, but it is the senior-most equity security. What does that mean? It means it has priority and preferences. So what are these preferences? Firstly, preferred shareholders are the first to get paid. If a company declares a common dividend, they must pay the stated preferred dividend first. In the event of liquidation, preferred shareholders get paid their par value before common shareholders can receive anything. Now, let's talk about par value. Remember, for common stock, par value didn't matter much. It's just a very small but random number. But for preferred stock, it's very significant. The par value of preferred stock is typically $100 per share, and dividends are based on this par value as a percentage. So if the company liquidates, after all the debt holders and liabilities are paid off, and money is left over, the net worth of the company, we first pay back the preferred shareholders their par value. Only after that do the junior-most security, the common stockholders, get paid off. This makes preferred stock the senior-most security with priority in both liquidation and dividend payments. For the purpose of the test, assume the par value of preferred stock is $100. The dividend is a percentage of this par value. Dividends for common stock are typically paid quarterly, but the test may present scenarios where they are paid semi-annually or quarterly. So read the questions carefully to understand what is being asked. An important point to know is that preferred stock doesn't have voting rights and doesn't receive preemptive rights. Essentially, preferred stock acts a bit like a debt security, but it is not. It is an equity security, representing ownership in the company. Here's a potential testable point. What's the rate of return on preferred stock? It's a percentage of the par value. For instance, 6% preferred stock pays $6 per share per year, which is 6% of the $100 par value. So preferred stock is similar to a bond because it provides income to the shareholder. However, there are key differences between bonds and preferred stock. Bonds have priority in liquidation and are considered one of the company's liabilities, so they get paid off before preferred stock. Bonds are issued with a set maturity date. For example, if you buy a 30-year bond today, it will mature and be repaid by the issuer in 30 years. We'll discuss this in more detail in the next section. Preferred stock, on the other hand, has an indefinite life, much like common stock. There's no set maturity date for preferred stock. Bonds come with a legal right to interest payments. But do preferred shareholders have a legal right to dividends? Only if the board of directors declares them. Alright, let's dive into a key concept that's crucial for both preferred stock and bonds, the inverse relationship between price and yield. We've already talked about dividend yield, but when it comes to preferred stock and bonds, we refer to it as current yield. So what's current yield? It's simply the annual income divided by the current market price. Now, let's make this practical. Say you own a security paying 2%. If interest rates go up and new securities are issued at 4%, what happens to your 2% security? Its market value drops. Why? Because it's less attractive compared to the new issues. Remember, interest rates and market prices move inversely. Rates up, price down. Rates down, price up. Bear in mind, only the market price is affected by the change in interest rates. The par value or face value of the security does not change after issuance. We'll revisit this concept again when we discuss bonds. This inverse relationship is fundamental to understanding market behavior for debt securities, or fixed income securities that act like them, such as preferred stock. Alright, let's tackle a question. Common stockholders and preferred stockholders both have what? A. Voting rights. B. Preemptive rights. C. Dividend rights. Or D. Subscription rights. Voting rights? No. Preferred stockholders don't have voting rights. Preemptive rights and subscription rights are the same thing, neither of which applies to preferred stock. What they do have are dividend rights. So the answer is C, but remember, they only have the right to the dividend if it has been declared by the board of directors. Here's another question. All the following are true of preferred stock except A. Dividends are paid before common. B. Dividends may be paid semi-annually or quarterly. C. Corporations must pay preferred dividends. Or D. Preferred shareholders are paid before common shareholders upon liquidation of a corporation. Alright, I'm looking for what's false here. Dividends are paid before common. Yes, that's true. Preferred stock has a preference. Dividends may be paid semi-annually or quarterly. That's true too. Now, corporations must pay preferred dividends. This one is false, because dividends are only paid if they're declared by the board of directors. Don't stop at choice C. Check D as well, because we need the best answer. You might think C sounds good, but let's verify D. In this case, C is correct, but D says preferred shareholders are paid before. Yes, that's right, which makes it the wrong answer because it's an except question. We want the only false answer, which makes C correct. Now, let's talk about the different types of preferred stock. First, cumulative preferred stock. What does that mean? Suppose we have 6% cumulative preferred stock, and the company had a lousy quarter. We don't have enough money to pay out dividends. Before we can pay any future dividends, we must catch up on any missed dividends for cumulative preferred shareholders. So any unpaid dividends accumulate and must be paid before we can declare a common stock dividend. Next, callable preferred stock. This means the issuer has the right to repurchase the shares from the shareholder at a future date. So, when might they do this? When interest rates fall. Suppose we previously issued 6% preferred stock when market rates were higher, but now we can issue 2% preferred stock because market rates are lower. The issuer can call in the 6% stock at par, buy it back, and then issue the cheaper 2% stock, saving money on dividends. Usually, the issuer calls the stock back at par, which isn't good news for shareholders because if interest rates fall, the price of the security goes up. But when it's called at par, the issuer is happier because they can then issue new shares at lower rates, saving the company money. Convertible preferred stock allows shareholders to convert their shares into common stock based on a fixed price per share or a fixed number of shares. For example, if we have a $100 par preferred stock that's convertible into 5 shares of common stock, the benefit for the shareholder is twofold. They receive dividends from the preferred stock, if declared, and can also take advantage of capital appreciation if the common stock price goes up. So whether the conversion is a fixed price per share or a fixed number of shares, it will be stated for convertible preferred stock, and it can be converted into common stock. Now, let's talk about participating preferred stock, also referred to as performance preferred stock. This type of stock allows shareholders to participate more fully in the earnings of the company. Suppose we have 6% preferred stock, but it's participating preferred. If the company has a very good quarter and makes a lot of money, they can declare a special dividend for participating preferred shareholders. For example, they might give them an additional 8%. So the dividend rate on participating preferred stock is set as a minimum, but there is no maximum. It depends on the dividends declared by the board of directors. Let's look at a question. ABC Company has outstanding 10% non-cumulative preferred stock. 2 years ago, ABC paid a 6% preferred dividend. Last year, ABC paid a 7% preferred stock dividend. This year, ABC wishes to pay a common dividend. The preferred shareholders must receive which of these choices? A. 0%, B. 7%, C. 10%, or D. 17%. So if ABC Company has 10% non-cumulative preferred stock and paid a 6% dividend 2 years ago and 7% last year. What will they receive this year? Did you say choice D, 17%? If so, you're wrong. The answer is C, 10%. Why? Because it's non-cumulative. You have to read the question very carefully. If you read quickly, you might think, oh, it's cumulative and they paid 6%, but it doesn't matter. The test may present with too much information. Essentially, information you do not need. It doesn't matter if the company paid 6% or 7% in the past. It's non-cumulative. To pay a common dividend, they must pay 10%. So 2 lessons here. Read the full question carefully and watch out for unnecessary information. Next question. ABC Company has outstanding 10% cumulative preferred stock. 2 years ago, they paid a 6% preferred dividend. Last year, ABC paid a 7% preferred stock dividend. This year, ABC wishes to pay a common dividend. The preferred shareholders must receive which of the following choices? A, 0%, B, 7%, C, 10%, or D, 17%. The answer is D, 17%. So the key difference here is cumulative versus non-cumulative. For cumulative, you need information on previous unpaid dividends because they accumulate. Here's another question. If interest rates fall, issuers most likely will 1. Call low interest paying preferred issues. 2. Call high interest paying preferred issues. 3. Replace the old issue with a new one at lower rates. Or 4. Replace the old issue with a new one at a higher rate. Our answer choices are A, 1 and 2, B, 1 and 4, C, 2 and 3, or D, 2 and 4. It's very important to determine whose perspective is the focus of a question. In this question, the focus is on the issuer. Issuers want to pay the lowest amount, while investors seek the highest return. Because issuers want to save money, they will most likely call their high interest paying preferred stock to refinance at lower rates. This is similar to a homeowner refinancing their mortgage to get a lower interest rate. So, when interest rates fall, issuers will call expensive securities to replace them with new, lower rate issues. So, the correct answer here is C, statements 2 and 3. A customer holds 100 shares of ABC Corp. $100 par convertible preferred stock, convertible at $20 per share. How many shares of ABC common stock will an owner have upon conversion? A, 5 shares of ABC common stock, B, 100 shares of ABC common stock, C, 500 shares of ABC common stock, or D, 5,000 shares of ABC common stock. Okay, let's work this out. The par value is $100 and the conversion price is $20 per share. So $100 divided by $20 gives us 5 shares of common for each share of convertible preferred. With 1 share of convertible, you get 5 shares of common. So for 100 shares of convertible preferred stock, you would get 500 shares of common stock. The answer is C, 500 shares of common. Which statements are true regarding participating preferred stock? 1. Shareholders participate in any bond interest payments. 2. Shareholders participate in extra preferred dividends declared by the board of directors. 3. The rate received is fixed as to the minimum, but not as to a maximum. And 4. The rate received is fixed as to a maximum, but not as to a minimum. Our answer choices are A, 1 and 3, B, 1 and 4, C, 2 and 3, or D, 2 and 4. Option 1 says shareholders participate in any bond interest payments. Well, no, that's not right. Shareholders participate in extra preferred dividends declared by the board of directors. The rate received is fixed as to the minimum, but not to a maximum participating preferred. Yes, that is correct. The rate received is fixed as to the minimum amount, but not to the maximum, because we can enable the shareholders to more fully participate in the earnings of the company by declaring a participating preferred dividend above the stated rate. So, the answer is C. Now we'll look at Section 5, Special Features. Let's talk about warrants. Warrants are another type of security, often seen alongside rights. You might see some test questions comparing and contrasting rights with warrants. Warrants are typically issued as a bond sweetener. When a company doesn't want to pay high current interest rates on bonds, they issue warrants. Warrants offer the investor the option to buy the company's stock at a specific price over a certain period. This additional benefit for investors allows the issuer's bonds with a comparatively low yield to compete with those with a higher yield, because those are not sold with warrants. Warrants typically have an expiration date far in the future, although some are perpetual. 5 to 10 years from issue to expiration is typical for warrants. They allow the investor to buy stock at a fixed price, usually above the current market price, so there's no intrinsic value when they are issued. Intrinsic value measures something's inherent market value. A $5 bill has an intrinsic value of $5, while a share of stock has no intrinsic value because the company the stock represents may be worthless. Because a right is issued below market price, it has intrinsic value when issued. Because a warrant is typically issued above market price, it has no intrinsic value. However, it does have time value. Time value is the value attributable to an asset that has a long time until maturity or expiration. So it would be correct to say that rights tend to have intrinsic value, but little time value when issued, while warrants have no intrinsic value, but significant time value when issued. When the investor buys a bond with a warrant, the investor gets both the bond and the warrant. The investor can separate the warrant and either sell it, trade it, or exercise it to buy stock. The key takeaway for now is that warrants are long-term, issued above market price, and usually can't be exercised immediately. Let's take a moment to review rights once again. Rights are short-term securities, typically allowing investors to buy stock at a price below the current market price. They're issued to existing shareholders to help maintain proportional ownership, but are short-term, usually expiring in 30 to 60 days. Rights have intrinsic value since they're priced below the market. Rights are short-term, while warrants are long-term. Let's tackle another question. Which statement is true concerning rights versus warrants when issued? A. Rights are long-term. B. Warrants are short-term. C. Warrants have intrinsic value at issuance. Or D. Rights have intrinsic value at issuance. Rights are not long-term. Warrants are not short-term. Warrants do not have intrinsic value at issuance since they're priced above the market price. Rights, on the other hand, have intrinsic value because they're priced below the current market price. So the correct answer is D. Rights are priced below the current market price and therefore have intrinsic value. American Depository Receipts, or ADRs. They enable stocks issued in foreign countries to trade in U.S. markets. An ADR represents shares of a foreign company, priced in U.S. dollars. If the foreign company pays a dividend, the ADR will pay the equivalent in U.S. dollars. Shareholders of ADRs are subject to currency risk, also known as exchange risk. That means that if the dollar strengthens against the currency of the native country that issued the stock, the value will decline in U.S. dollars, even if it doesn't decline in the foreign currency. Some key points to remember. ADRs are equity securities, representing foreign shares, priced in U.S. dollars, and trade in U.S. markets. Dividends are paid in U.S. dollars. Because it is based upon the value of a foreign asset, it is subject to currency or exchange risk. Typically, a foreign offshoot of a U.S. bank buys the securities and issues a receipt in U.S. dollars. This then facilitates the foreign company's stock to trade on U.S. exchanges with fewer regulatory hurdles. Finally, it's important to note that the owners of ADR don't have voting or preemptive rights. Like U.S. stocks, they must be registered with the SEC prior to sale. They may sometimes be referred to as American depository shares. When a U.S. firm cooperates with a foreign issuer, the issue is said to be sponsored and it can trade on major exchanges. Unsponsored ADRs are issued by a U.S. bank, but have no connection to the foreign company. They must trade over the counter. Additionally, ADR holders may be subject to withholding tax. For example, French companies may withhold tax on dividends paid. U.S. investors can claim a credit on their U.S. tax return for these payments. Here's a question. American depository receipts only pay dividends in A. Euro dollars, B. European currency units, C. Foreign currency, or D. U.S. dollars. ADRs only pay in D. U.S. dollars. That concludes our review of Chapter 1. Up next, we'll talk about Chapter 2, Debt Fundamentals.